We are also live on Facebook. If that's something that you guys want to watch afterwards, certainly you guys can email us as clients to get a webinar link for this. But also if you reach our Facebook page, which we've been putting up a little bit more content there, and we'd love to share that with you guys over time. But that's some place that our webinars, some other a series that we're doing called Money Mythbusters is where it shows up. It's actually coming up at 4 o'clock after this one. So feel free to join us there. But let's get started. A lot of the clients that are in here will know Nathan and Raymond, but a quick introduction. Both of these guys are our co-founders, so thank you to them. I've got a job, right? So, but it's always fun to work with these guys. And again, today we're going to talk a little bit about investing. Before we do that, how are you guys doing?
It's good. Yeah, it's Friday, ready for the weekend. Yep.
Yeah. Although, what's the difference between weekend and work week right now? We're always just at home, right?
The same, but
a little more relaxed, I guess.
Not on emails per se, right? But and then the quick things that we have to go through in the beginning before we get started, because today we are talking about investments. Okay, so we want to be clear that, especially in a webinar setting, outside of our clients, anything that we talk about in terms of investments isn't a solicitation or an encouragement to buy a certain investment. What we're talking about really is just the idea of how to invest, the general sense of that education behind it, okay? If we're looking for specific investments, we're gonna chat with you guys as clients one-on-one about how to take this further if there are questions that come from there. In addition to that, for our general audience that's watching, right, things that we talk about on these webinars or any of our streams on Facebook is really for general education and not meant to be personal financial advice, because we don't know enough about you for the audience to really do that, okay? Finally, any tax things that we talk about, for example, things like long-term capital gain, short-term capital gain, things that have to do with investing taxes today, again, think of it as from an education purpose, right? These things in particular should be things that you discuss with us either later in detail as clients or with your tax preparer, all right? So let's get started. Let's get started by talking about where the confusion comes, right? When people are getting started to invest, or even if you're invested, understanding your own investment. So before I throw it over to you, Nate and Raymond, I'm gonna talk a little bit about like what I normally hear, right? Like what is the statements that I hear when people talk about investing. So it'd be like, hey, Alfred, I think my IRA is an aggressive investment. So they'll state the IRA, the account itself, like I'm aggressive, or I want to go ahead and open a mutual fund. Like they'll say it like that. I want to open a mutual fund and invest. Okay. Or the other thing that they'll say is, you know what, I want to, open a Vanguard account because I want to invest in Vanguard funds, right? So those are these things that come up. Or one more thing is like, hey, this ETF I want to buy, this ETF must be aggressive or must be conservative, right? So there's these attachment of risk to different investment vehicles, or just a confusion around the basics of how you actually set up a dollar that goes into an investment, right? So we're gonna break that down a little bit into categories of what actually is attributed to risk, what is actually just a vehicle to invest, and what is just something that holds all of it together. Okay, so we're gonna start there. So Nate, tell us a little bit about the account types, the idea of that my IRA being aggressive or my brokerage account being aggressive. So tell us a little bit about the account types itself.
Yeah, absolutely. So I think of those three buckets you mentioned, the accounts are really just a place that holds your investments, right? So the accounts themselves do not dictate your investment strategy. They don't dictate what you must hold necessarily. They're just a holding place. So you would be able to put, dollars into these accounts, and then from there, you'd be able to decide, I want to buy stocks or mutual funds or ETFs. And that would then dictate your investment strategy. So on the accounts, the way I like to break it down is you have accounts that you contribute to before you get your paycheck, and you have accounts you contribute to after you get your paycheck. And so some common accounts that you may have heard before paycheck is 401k, right? So 401k, maybe you're a government worker or a teacher, maybe you're familiar with 403b, 457. They all function the same way in that they're stripping out dollars from your paycheck and contributing to that plan before you even see your paycheck. And so 401k itself is a form of retirement account. And within the 401k plan itself, depending on your company and how they structure it, you can have what's called pre-tax dollars, or you can have Roth dollars. Pre-tax dollars means that you're putting in the money before any of it is ever taxed. And so when you take that money out at retirement, you will then pay tax at ordinary income. Roth is the exact opposite. You're putting in money post-tax, so it already had the tax withholding for you. It's going into that Roth 401k and getting to grow tax-free. But the most important piece here is that you're contributing to that 401k through your payroll system and before that money goes into your checking account for deposit. Once you're in the checking account for deposit, now let's briefly just cover the post-tax or post-payroll type of accounts.
Mm-hmm.
Once that money has been deposited into your checking account, most people are familiar with just a brokerage account. A brokerage account is not a tax-deferred vehicle like your retirement account. It's not Roth, so it's not tax-free. Brokerage account is something that you will have capital gains on as you sell your investment, which we'll cover capital gains in just a minute. But brokerage accounts are liquid accounts, just as liquid, maybe slightly less, but generally just as liquid as, say, a checking or a savings account. The difference between a checking and savings account versus a brokerage is that your brokerage, you can buy Amazon stock, you can buy an ETF, you can buy a mutual fund, but it is an account that you contribute to once your payroll has been received in your checking account and you deposit it into the brokerage account. Then you get to decide what you want to invest in. Conservative, aggressive allocation. Again, a brokerage account is just a holding place for your dollars, for your investments, therefore for your investment strategy. Also, from your paycheck being deposited into your checking account, depending on your income, you can contribute to another retirement account called an individual retirement account. This can be in the form of a traditional IRA, which is the same as your pre-tax 401k, and that you get a tax deduction for making that contribution. You pay tax on the back end in retirement, or a Roth IRA, which again, you don't get a tax break for now, but you get to have that money grow tax-free. So IRAs are retirement accounts that you can contribute to that have a tax advantage to them, but you contribute to them once you've received your paycheck and as a contribution from your checking account. 401k is directly from your payroll. So that's two of the major differences in IRAs versus 401ks. Outside of that, you have your brokerage account, which is just a liquid account, meaning that you can sell it, you can put it back into your checking account, you can use it. There is no time restriction on when you have to use that money, whereas 401ks and IRAs, you generally have to be at least 59 and a half before you can use that money. So brokerage accounts are what we consider liquid money, which are things that people may use for a house, down payment, for a car purchase, some of those shorter term goals. But a brokerage account is what allows you to invest in ETFs and mutual funds, et cetera. If you're a parent, if you're a child, you may also be familiar with the custodial accounts. They may be called UTMA or UGMA accounts, Uniform Transfer to Minors, Uniform Gift to Minors account. Again, it's a custodial account that allows children to invest in the stock market through ETFs, mutual funds, individual stocks, but it has to be owned by the parent until that child is 18 to 21, depending on the state. So those are just kind of the high levels of all the different investment accounts that you can have. But again, the investment account does not dictate how you're invested or what you own.
Yeah, and that's what a key point to bring up, right? Like you name so many accounts, and that sometimes in itself is confusing. But if you generalize all those different account vehicles, right, you can see how, like when somebody says my 401k has to be aggressive, or it's like that association with risk to the account type isn't what is causing the risk, right? The account type itself, again, is just what holds it. So that's a summary of that top part. Now that we have that vehicle of what holds these things, right? What goes into it? Like, what's the next thing, right? In terms of investment vehicles itself, like actually getting the dollars to grow, we call them investment vehicles. Break down some of those investment vehicles for us, Nate, in terms of the different types, individual versus baskets. Like, how do we dive down into that?
Yeah. So, I mean, the stock market started with individual stocks, right? So people had to have a broker back in the day to allow them to buy into companies of individual stocks. Over time, people wanted to make it easier to sell investments and for you to gain access to investments. So mutual funds came around. And then in the 80s and definitely became wildly more popular through the 2010s, ETFs. became another popular platform. So mutual funds and ETFs are a very common way for people to invest. All it does is it baskets your investment. So you can have an ETF that tracks the tech sector, and that tech ETF is going to buy the top 50 largest technology companies. Maybe it's Amazon and Salesforce and Adobe, et cetera, right? And so all it's doing is buying the top 50, and it doesn't even have to be 50, it could be 100, it could be 150, but it's basketing those individual stocks into one fund that you then invest in. And as the individual names within that fund fluctuate based on the individual stock performance, the fund aggregates that performance, and you see that be reflected in the ETF price. Same thing with mutual funds. Mutual funds, again, are a basket of holdings. And when I say basket of holdings, it can be individual stocks like Adobe, Microsoft, Apple. It can be individual bonds. It can be real estate holdings. It can be gold holdings. The ETF or a mutual fund, just because it's a mutual fund or just because it's an ETF, again, doesn't dictate the risk. It's just a holding place to aggregate a lot of individual holdings into one strategy. And so ETFs can be conservative, ETFs can be aggressive, but all it's doing is buying those baskets, and those baskets is what you need to understand as far as how your risk is dictated. Now, if you don't want to buy ETFs or mutual funds, that's totally fine too. You can take on individual business risk. You can take on a little bit more of the homework yourself and say, I don't need a fund manager to decide on what those basket of holdings are. I'm going to go and buy Amazon stock and Adobe and Microsoft and Apple on my own. And you don't have to use an ETF to do that. You can buy those individual names inside of your IRA account, inside your brokerage accounts. Generally, 401ks are the one account where you may have some restrictions on how you're invested. Usually they're more of the mutual fund variety. But again, you get to make that decision of how you're investing in ETFs, mutual funds, or individual names. And I say individual stocks, that's not to stop you from also being able to invest in individual bonds. If you have a Schwab account, a TD Ameritrade account, their trading desk can help you buy an individual bond certificate from San Francisco County or the state of California or a U.S. Treasury bond. And it's an actual certificate that is held inside of your account that would then mature over whatever time period you're buying that bond for. So just like Amazon stock exists as an individual name, bond certificates also exist as individual names. All that ETFs and mutual funds do is they aggregate many individual holdings to create an overall investment strategy for you.
Yeah. And so if you think about that, right, as Nate mentioned, the basket, right, the basket itself, it's just how often someone is shuffling that basket. If they're shuffling more often, it's more active, then it's usually the mutual fund type, which then has more of a fee to it. If the basket is set, more of a set it and forget it, it's tracking something, then that basket would be considered exchange traded fund, right? And ultimately, right, if that basket is filled with risky things, the ETF is risky. If the basket is filled with conservative things like bonds, it will be on the conservative side, right? So again, now we're talking about not only the account type, but getting into the actual investments. And that's where you make the choice of how risky we are or not, right? So just want to be clear, you're selecting the risk, or we're helping you select the risk based off of your goals, right? What are we trying to accomplish? If it's in a retirement account, maybe more risky because we can't touch it till 59 and a half and beyond. If it's in a brokerage account, we're thinking about buying a house in the next 2 to 5 years, right? Thinking through that as a way to develop your risk. And maybe that's a good point, Nate, just to pause for a second and say, from a risk tolerance perspective, especially given like all the crazy things that's going on in the market right now, like how do we settle down some of that white noise that happens, right? I mean, uniformly, I think all our listeners right now is going to say, the market doesn't make sense. Why is it so high right now? How do I make sure I can keep investing? What's going to prevent me from making the decision not to just pull all my money out of my account? Like, what's the fundamental thing that we talk about to help silence some of those, that white noise that's out there, to focus on what's important?
Sure. Just to pause really quick, I think we had one question come in that was applicable to what we just talked about. So I just want to tackle that really quick. And that's for grandparents to grandchildren. Same accounts can apply. You can still open a custodial account for your grandkid. You can also open a 529 account if you're trying to save specifically for college. Now that's going to have a little more restriction on what you can invest in on that 529 plan. But again, that's something that a grandparent can open for a grandchild, or if they want a little more freedom of choice, not necessarily having to use it for education, they can also open up that custodial account for their grandkids. So just wanted to tackle that one really quick.
Awesome.
Now, as far as kind of how we try to get rid of that issue of like wanting to always pull out or come across that, I mean, the way I think about stocks to begin with is we're investing in corporations that historically continue to grow in size, right? Amazon, Netflix, et cetera. They continue to hire more people. They gain more revenue share. We're investing in the ability for corporations to grow their companies over time, right? As much as, you know, we wish we would have been Amazon investors in the early 2000s, doesn't mean today can't be a good time to invest in Amazon still. They're doing a ton of amazing things that's going to continue to gain more market share or gain more revenue for them as a company. That's going to hit their bottom line and be a result of appreciation in their stock price over time. I mean, Warren Buffett is one of the greatest investors of all time. He says the best way to fight inflation is to invest in stocks, right? Yes, the rules may change. The economic data may change. But we believe in the executive teams at these companies to adjust to those new rules, whether it be tax or government regulations, to continue to grow their companies over time. And that's the important piece. It's over time, right? We don't necessarily know what 2020 performance looks like, but we know the 30-year historical average of the S&P 500 is over 11%. There's going to be years like 2019 where we're wildly over that. There's going to be years where we see a 35% correction like we saw this year. But even with that 35% correction, where are we now? The market's back to neutral. In the case of the Nasdaq, market's actually positive 20%. And so I think as long as you have that conviction that you understand what you're investing in, knowing that stocks and companies will continue to grow over time and they will adjust to the new tax laws and government regulations, it's going to give you a little more conviction to stay invested, especially as the fluctuations in the market happen, and recognizing that markets move faster than ever. Here we are in August, and we were talking about a 35% correction in March. All of that is recovered by now. It took 4 months, 5 months to fully recover a 35% market sell-off.
Yeah.
Now, if you're investing in things that, you know, maybe you need shorter term, like maybe you mentioned, hey, I'm buying a house, right? I think I'm going to buy a house this summer. You don't have time to recover those losses. So for someone that had the expectation of buying a house in summer and they saw a 35% correction to their portfolio in March, they're probably going to panic, right? They're probably going to panic. They're going to sell and say, I'm just going to get out whatever I can. So hopefully I can still buy that house this year. That's where investment strategy comes into place, right? So not all investments have that same volatility of, oh, we saw a 35% correction in the market. Bonds didn't see that same correction in that same time period. And so we kind of look at a blend of investment strategies. If you have a shorter time horizon, bonds make a really smart part of your portfolio, right? The average historical return for bonds over 30 years is a little over 5%. Now, the average performance difference from year over year, or standard deviation, as we call it, for bonds is only a 4.5% swing on average every single year. So a really bad year for bonds might be negative a few percent. A really bad year for stocks is negative 50%, like we saw in the financial crisis. And so it's really understanding how much can your investment sway historically. Now, you know, obviously history doesn't repeat itself and we could see wilder swings in the future, but we're understanding the generalities of what we're investing in. Bonds, yeah, we're going to give up some return potential by investing in something that doesn't grow as great over time, but we're also not going to be stressing to say, oh, shoot, the market just fell 35%. I was trying to buy a house in 3 months. That's a real huge concern. And so bonds need to make a part of your portfolio. And that's why we talk about maybe shorter term accounts being more conservative, investing in things that hopefully can beat inflation, which is what bonds historically have been able to do. Not earning a lot, but bonds this year are up 7%, but not a lot of sway, right? And so that's what we're talking about. Conservative needs to have some bond allocation, things that have modest returns, but very minimal sway in performance. Midterm and longer term, you can stomach the volatility of stocks, And that's where longer term, we want to be invested in stocks to maximize the growth of your investments.
Yeah, yeah. And ultimately, you have to remember that each and every one of you, the emotional side is actually, especially for someone who's investing in their, like someone who's investing by themselves, right? Like it's not, removed, you're not having an investment manager do it, right? Like the emotional side is almost just as important when you're thinking about your investments. The times in which we see, right, like investment really go sideways is the idea that, look, I'm nervous about my account. I need to pull my money out, okay? And they do it, right? Like they actually do and pull their money out. And then the market rebounds. Now, okay, like one of 1,000 clients, okay, right? I'm smiling because we have somebody who's like, hey, we want to pull out of the market, and it happened. They pulled out at the top, they got back in the bottom. Good for them. But remember, when they do that, they're not being less aggressive, or sorry, they're not being more conservative. They're actually being more aggressive, right? They're flipping a coin to say, when I pull my money out, I'm betting that it's going to go down further. It's a bet at that point, right? And so for most longer term investments, I don't want to be making bets, all right? I want to be making consistent returns, right? And that emotional side of investing, you need to understand yourself. Am I the type of person that will get nervous, right? And all of a sudden, just make a decision that makes sense emotionally, but may not make sense long term, right? And if that's the case, you need to think about the tolerance, the sway that Nathan is talking about. You need to have your portfolios probably have less sway in it, right? So it's not to a position where that sway is too much and now I'm getting nervous, okay? And of course, this is something that you learn about, right? You learn about yourself as you're investing and going through that process is how sensitive am I to news and market adjustments? Some people aren't at all, right? Like some people say, oh, I put it in, it's great. And for those clients, probably the more aggressive, the more sway set, as long as they don't need the money, makes a lot of sense for them, okay? So it's starting with the idea of aligning the account or the investment to the goal that it's needed for, and then adding in the sense of, yes, this is a long-term account, but I'm really nervous most of the time about my investing. I shouldn't be too aggressive anyway, because my emotional side may kick in. And if you make a wrong time to buy and sell, that actually has much more of an impact to long-term success of the investment account. Okay, right? So
I don't think any fund manager can tout that they consistently get the market timing correct, that they consistently get out of the way and know when to get back in. I mean, they may get it right once in their career, twice in their career, but nobody can consistently time the market. There's no way. I mean, how many people missed the 35% correction that happened this year? Well, probably not that many because it happened in a matter of 4 weeks. But even if you were out of the market, let's say end of 2019, thinking that something was going to happen sometime in 2020, probably more related to the election than this obviously global pandemic that none of us could have predicted. But then did you invest that money after that 35% correction happened? Like most people were thinking, oh, it's not 35, it's going to be a 50% correction.
Right.
And guess what? 3 months later, the market's back at all-time highs again. So with the market moving faster than ever, does a pullout strategy ever make sense? And my response is no. Nobody can guess right twice. You may get it right that you missed that drop, but I bet you did not invest that money in time to get back into the market. I still have people wondering when they get back into the market. And so I can never get behind a pullout strategy ever, especially for longer term accounts. You're just not going to get it right twice. The best fund managers in the world can't get it right twice. So who are we to think that we can do it correctly when they cannot? And they have much, much more research ability than any of us have. And so I believe in not a hold it and leave it strategy, but more of a tactical approach, right? You can move your portfolio from, emerging markets to small cap, or large cap to small cap, or small cap back to large cap, but moving the money from large cap or just general stocks to cash, I think that's very, very dangerous.
Yeah.
Because you're going to find yourself many times just wondering when do you get back in, and you would have missed all of that upside.
Yeah.
So I would say pullout strategy is not a strategy at all.
Yeah.
It's making sure that you're allocating your strategy to the right time frame.
Yeah, absolutely. And we're adamant about that. We're strong feeling about that. You can see the emotion behind Nate when he's talking about this. Why? Because it makes us really nervous when a client says, hey, Alfred, I think the pandemic is gonna, drop the market 50%. I want to pull my money out. Here's the thing. We agree, like that feeling, right? Like the feelings are always right? Like we feel the same way that the market is gonna have some really rough days, okay? It doesn't feel good when the market's down 10%, but guess what? It's how you react to that, right? And back to Nate's point is that, the reaction, the pulling out, the nerves that you get when markets are down 35%. Think about this. This was March 23rd, so not that long ago when that happened. On March 23rd, it would be hard to believe that a lot of people, right, are saying, hey, you know what? Like, it's time to go back in the market. A lot of people were instead thinking about, right, like I should hold on for a little longer because I think there's more downside coming. And I think that's the toughest part about it, right? And so remember this, right? Trying to time the market, whether it feels like I'm actually taking risk off the table, right? Because I'm removing money away from the market, so I'm taking risk off the table. By doing so, you're actually putting your longer term goals at more risk. It becomes then a gamble, right? So just being very clear about that, okay? And so a question came in, it's like, hey, when I'm investing in stocks, when should you pull out of the market, right? And so I think based off of what we just said right now, right? If you're gonna be investing in stocks, you should start out by thinking, how long is this money gonna be in the market for, right? If it's gonna be in the market for long term, then picking the right stocks, shuffling around stocks. So again, to Nate's point, not just keeping one stock forever, that doesn't have to be the case, but shuffling it around. Am I in a US stock? Am I in an international stock? That is all fair game to shuffle around, but you're still invested, right? But pulling that out, right? Why are we pulling that out, right? Are we pulling that out because we need the money, right? That's a different story. That's the liquidity part of it. But from an investing perspective, right, you really should still be investing long term. And it's kind of hard to think like, oh, if I'm investing, I gain money. If I never pull it out, do I really make money? Well, really, right, it's supposed to be gaining long term. And then over time, your liquidity goals change, right? I'm heading towards retirement. I might need this money now. You see, again, I'm tying back liquidity. That's the reason when you should be thinking about adjusting your allocation. So technically pulling out of the stocks when your liquidity goals get closer and closer, right? That's the way to think about it. Okay.
And maybe just to add some specifics to this. So my general philosophy is if you're planning on using any money with high conviction that you're going to use that money in say 12 months or less, it doesn't give you much time to be invested in stocks. So maybe some bonds could make some sense, but I generally still recommend just putting that money in savings, given how volatile the markets have been in the last few years. If you have maybe a year to 3 years, maybe something like 20% to as much as 40% in stocks on the very, very high end, and then the rest of it in some sort of fixed income allocation. Somewhere in the 5 to 10 year range, I'm a lot more comfortable to say kind of the Warren Buffett model of 70-30 is more appropriate, and 10 years plus probably 100% stocks. I do also see a lot of clients calling up these what they feel binary events, right? Hey, I just retired. Guess what? Like a lot of our retirees in the tech space, you're like 55 years old. Hopefully have like 40 more years of life, right? And so it doesn't have to be 100% stock allocation going to 0% stock allocation just because you're retired. That money is supposed to last you for the rest of your life. So don't think necessarily just because you're retired, just because you're drawing income from an account now that you cannot have stock allocation.
Absolutely.
I think that's a common misconception.
Yeah. And again, right, it's this gradual shift, right? Like, and that gradual shift from being more aggressive, slowly taking stock out, taking money out, right? That gradual shift should be how you think about moving accounts around, right? Like, if you're making drastic shifts, like we really have to ask why we're doing that. Like, why are we making huge shifts? Is it because something really drastic happened from a life and liquidity standpoint? Because if not, we probably shouldn't be making a drastic shift in the account, right? And so those things all have to line back up. I'm going to summarize a couple of things here. Before I do that, Nate, Raymond, anything else to add in terms of what we want to cover?
Probably just going back to one of the account types when clients start creating accounts. I feel like a common question that we get is, what is the difference between a traditional IRA and a rollover IRA account? So when we have clients, when we recommend clients to create an account and fund it with an IRA contribution, they'll run into that issue when they're trying to create that account, right? And just to clear that out now, they're the same accounts. There's no difference in terms of the vehicle and it being a retirement account. It's still going to be pre-tax. It's really just a way for clients to distinguish between whether it might have been a rollover from a previous 401k going into an IRA account, or traditional where clients are just putting contributions in there. Okay, so they're still the same exact account. Clients can transfer funds between both accounts without any issues. That's a common question that I feel like we get when clients are creating accounts. So
Yeah,
just want to clarify that.
absolutely.
One more for me to add too, and that's the popularity of Robinhood, right? Robinhood Stash is another one. Where I think a lot of these accounts actually make a ton of sense is their implementation and available trading with fractional shares, right? So up until this point, you had to have $3,000 to buy one share of Amazon. If you want to in Robinhood or Stash, you can go buy $100 of Amazon stock. And so where these I feel become much more applicable is for newer investors or those custodial accounts that we spoke about, trying to get your children to pay attention to the stock market, get into some stocks that you're familiar with. Like, hey, does your kid, play video games? Great. Well, maybe EA stock or Activision might be a interesting investment. Do you guys as a family have a Tesla? I'm sure your kid's super interested in Tesla, right? But the problem is a lot of these stocks are like really high in performance this year. Tesla's up like 200%, Zoom, DocuSign, up 200% this year. And so it's really tough for me to say, hey, go put $10,000 into Tesla right now. But the benefit in the fractional shares is you can buy, $100 of each of your favorite names. More importantly, where I really love Stash is their recurring purchase feature. You can say, hey, Stash, help me buy $100 worth of Tesla stock every single week. And so even for, maybe more sophisticated investors, we can talk magnitudes of an extra zero or two behind the amounts. But this is not something that the traditional platforms like TD Ameritrade can offer, where you can actually dollar cost average with a specific dollar amount into specific stocks. So I think that's a really cool feature, because now you're not having to use as much market timing to say, yeah, August 7th seems like the best time to go buy some Tesla stock. You can say weekly, why don't you just help me dollar cost average, so buy the same dollar amount consistently every single week to help me build my position over time. Yeah. I think that's a much more valid strategy in trying to buy into some of these NASDAQ names that are so wildly popular this year. I mean, trying to chase something that's up 200% this year just does not feel prudent. But if you can buy it in many increments over time, building a position could make sense instead.
Yeah. And to tie that back into account type, right? Robinhood is the places that hold those accounts. Okay, right? So what I mean by that is, right, a Schwab, a Vanguard, right, a Fidelity. That's the company that houses those accounts. And within a Schwab, Vanguard, Fidelity, you can open up the brokerage account that Nate's talking about, the IRA that Ray's talking about, right? Robinhood, though, I believe, and this may have changed, but I don't think Robinhood at the moment allows for as many account types, okay? I think in looking at their site, like they allow for individual or brokerage account as what they hold, but not necessarily like an IRA account type yet, okay? And so, if you're thinking about, of investing, right, and you want to have a brokerage account, then I think Robinhood and Stash are good options to have. If you have more rollover accounts or different retirement accounts, then that might be a little bit more difficult, at least for now. I think they're thinking about rolling it out, right? And I hope they do, because it opens up more of that platform, and it's really cool to be able to have clients, especially maybe in a smaller Roth account, to be able to use something like that would be amazing, right? And so, and then I had one more question come through, and because it's an anonymous question, I want to be able to answer it since we won't be able to email them back after. The question was, mutual index funds, right? Are they out of style? What is the difference between mutual index funds and ETFs? Okay, and so, look, I think people talk about index funds because they track an index, right? Like that's the idea of using an index fund. And so, if it's tracking an index, how much adjustment is needed to do that? Right? I think that's a question to be asking. Like, how much active adjustment is needed to follow a certain index? And so because of that, I think a lot of people would believe that, hey, it's not very hard to follow the S&P 500, or it's not very hard to follow the NASDAQ. I just want exposure to the NASDAQ in a very cost efficient way. And because that is the case, many people have leaned on using ETFs for the index fund side, right? Because the ETF tends to be a more passive and cheaper way to make that investment. It's just that, right? I don't know if it's over the next decade. It's been a while where ETFs have really come on scene and taken over a lot of that, right? A mutual fund, if it's a mutual fund that just tracks the S&P, then sometimes it would be difficult to justify the cost. That's the way that we think about it. However, if it's a mutual fund that does something very specific, right? And it does need some adjustment. If we're getting ourselves exposed into maybe the smaller companies in the US, and I want someone really to understand these companies, then guess what? I'm willing to pay that fee, which is higher, to get that exposure. And of course, hoping that it performs well too, right? So I think those are the key differences around the mutual fund versus an ETF, is that if it doesn't need so much adjustment and it's something that I just want exposure to, we lean towards ETFs, right? And again, or the ETF style of investing, whereas mutual funds is something more specific exposure that I'm trying to get out of it.
The one place I think mutual fund index funds might have a place is if you're trying to set up a recurring purchase.
Good point.
Right. Unless you're using a robo platform that are buying ETFs for you automatically, which you pay a fee for. You can use mutual funds to set up recurring purchases, whereas you cannot do that on ETFs for most, traditional platforms like TD and Vanguard and Schwab. And so, there are low-cost mutual funds that track an index, and that would allow you to automate those purchases. That's the only time I think it makes sense to use them.
Yep. Agreed. Right. And that's where I think, right, people have this love for Vanguard, right? Because the Vanguard mutual funds tend to be cheaper than most other mutual funds, right? It might be a little bit more expensive than their ETFs, but the Vanguard mutual funds allows for what Nathan is talking about, is that kind of monthly contribution, and people do really like that, right? And so again, something to think about, right?
Do you want to bust that myth about Vanguard's platform?
Oh, about why you can't hold other things or buy other things in it?
Oh, I was thinking the other way around though too. So right, everyone loves Vanguard, and so they'll open up a Vanguard brokerage account or retirement account, and they want to buy Vanguard funds. You don't have to do it at Vanguard, right? You can buy Vanguard mutual funds, Vanguard ETFs at any platform, whether it be Schwab, TD Ameritrade. So don't feel like you have to use their antiquated user interface on Vanguard. Like, the platform, they need some work on their website. Hopefully Vanguard's not watching this. They don't sue us, but I mean, it's a little old, it's a little dated, it's a little tough to manage. So I prefer, a Schwab, which you can buy Vanguard funds on Schwab. So not saying Schwab is the place to go, but it's just a myth I wanted to bust. You don't have to be at Vanguard.com to buy Vanguard funds.
Absolutely. Right. So, and we like to call like Fidelity, Schwab, TD, right, open platforms for that reason, that you can buy any company type, right? Like any company sponsored ETFs, like a Schwab ETF, Vanguard ETF, right? Like you can do all of that in those open platforms. So give yourself the ability to do that, right? Open it up to yourself to be able to have that exposure. And I think that's where it can be key. Okay. Awesome. Well, I think we covered a lot. I think we were able to go through some of the questions that people had as well. Again, if you really want to dive in more individually with us, right, for our clients, reach back out to us. Talk about, right, what it means to have these different accounts, right? Most of you already have it set up, but if you're just getting started with it or getting your accounts reorganized, I think this is the perfect webinar to understand how to do that. All right. I think that's it. And we're going to close out the webinar here. I wanted to thank our attendees, of course, thank those that were watching our live stream as well. We hope to continue to do these webinars, just continue to put out more content for you guys and be able to absorb and learn some of these topics that, of course, we're passionate about, but it's also something we know that can be difficult to understand by just looking at Google or looking at the web. So we hope you guys enjoyed that.
Awesome.
All right. Thank you. All right. Bye.
Bye.